There are losses, there are small gains, there are flats. That's part of trading. The key to a good trader is to know when to exit and just follow those charts. Let them guide you. Don't force your input on a chart. Let it tell you when to enter, and the same thing, let it tell you when to exit.
In the latest Gareth Soloway's interview, he's discussing trading strategies and emphasizing the importance of knowing when to exit a trade. He also advises all traders to rely on charts and let them guide their decisions, rather than imposing their own opinions or emotions on the market, which we know one of the most important parts of trading is not to let your emotions eat you up, which may cause you a reckless decision and a regretful choice. Gareth also highlights the importance of recognizing that successful trading is not just about specific stocks, companies, or cryptocurrencies. Instead, it revolves around understanding and navigating the emotions that drive market participants. He explains that people often buy out of greed, hoping that prices will rise and bring them profits. On the other hand, selling is driven by fear, as individuals believe that prices have become unreasonably high and want to exit their positions. Gareth's insight emphasizes the significant role that human psychology plays in trading decisions, emphasizing the need to comprehend and navigate these emotional patterns to achieve success in the market. Gareth also explains that regardless of the type of chart or market being traded, the principles remain the same. He believes that all charts, whether it's for cryptocurrencies, gold, silver, commodities, or stocks, have equal significance. This is because the reactions and behaviors of traders tend to follow similar patterns across different markets. In this approach, Gareth emphasizes that his trading methodology can be universally applied to various assets. It doesn't matter if you're trading cryptocurrencies like Bitcoin, precious metals like gold and silver, commodities, or traditional stocks. The underlying principles and techniques he employs can be effectively utilized across these different markets. By adopting Gareth's methodology, traders gain a versatile and adaptable approach that can be applied to different financial instruments. This allows them to leverage their knowledge and skills across various markets, enhancing their trading opportunities and potentially increasing their chances of success.
The line is, when it comes to trading, you have to first realize that you're not trading stocks, companies, cryptocurrencies, you're trading human emotion, right? So it doesn't matter what chart it is, the technicals will work for it. It could be oil, it could be gold, it could be silver, it could be Bitcoin, or it could be Apple stock. The bottom line is, people buy because they are greedy, they think price is going up, and they sell because they're fearful, they think price has gotten too high and they want to get out of the position. So all charts are equal, meaning that if you have 1 million people trading any chart of anything, the reactions, the discipline, everything that goes into that is going to be the same. Once you realize that, you start saying, okay, well, I can trade anything out there. And that's why the methodology that I use is amazing, because it's applicable to anything out there. Crypto, gold, silver, commodities along the way, stocks, and everything else.
Gareth acknowledges that counter-trend trading can be dangerous if one lacks knowledge and experience. However, once traders become proficient in reading charts, they can identify levels where high probability points for reversals may occur. Soloway emphasizes that these patterns and levels have repeated throughout history, spanning hundreds and even thousands of years. He refers to historical events such as tulip mania in the 1500s and ancient Egypt as examples of chart patterns repeating over time. By recognizing these patterns and levels, Gareth aims to capitalize on potential reversals and play the market accordingly. He stated the importance of letting probabilities guide his trading decisions. He also refers to a specific chart of Bitcoin, mentioning a bold call he made when the price was near $69,000, which became one of his renowned predictions. He recalls how many individuals were confidently predicting Bitcoin's price to reach $100,000 by the end of November, followed by even higher targets like $200,000 or $500,000. Gareth points out a trend line on the chart, stating from a high point around 65,000. He mentions that although the price of Bitcoin crossed that line a few times, many people considered it a breakthrough. However, he advises caution and explains that for a breakout to be confirmed, there should be 2 consecutive higher closing prices.
Essentially, you're looking to generally go counter trend. Most people will tell you that that's the scary thing to do, and they'd be right. If you don't know what you're doing, counter trend trading, meaning if stock is falling dramatically, it's very dangerous to pick it up. Once you learn how to read the charts essentially guide you to the levels where the high probability points are where a reversal will take place. So I'm looking at these different things that have happened for hundreds of years in the charts, in fact, thousands. You go back to the tulip mania in the 1500s, you go back to ancient Egypt, and you chart anything, you're going to see things that basically do replications. And all I'm doing is recognizing those, finding the levels where those will turn around, and I'm playing weighing those accordingly, letting probabilities take their course. So if we look at my chart here, we have a chart where this is the chart of Bitcoin, and it's probably the most famous call that I ever made when we were at near 69,000. I said, guys, don't trust this. Everyone else was extremely bullish on Bitcoin, saying it was going to be 100,000 by the end of November, and then 200, 500,000 after. I looked at the chart and I saw multiple signals telling me that it was going to be a reversal and most likely a cycle top. So the first thing is to take a look here. If we draw a trend line from that first high, which was around 65,000, and we bring it right across, notice how price on Bitcoin did get above a couple times. Okay, now most people would say, oh, that's a breakout, right? And that's the common theme that we saw, is people saying, oh, it broke above the previous high, now it can go to 100,000. The confirmation signal tells you that when something gets above a previous high, meaning people think it's a breakout, you need to see 2 consecutive higher closes for it to actually be considered a breakout.
In the next part of the interview, Gareth explains why he believes that algorithms and institutions often manipulate the market by pushing prices above previous highs and then quickly reversing them. This tactic aims to trigger stop-loss orders or short positions and entice others to enter long positions, causing most traders to be on the wrong side of the trade. Gareth suggests that this manipulation occurs frequently in various markets, including stocks and cryptocurrencies. He proceeds to analyze specific chart indicators. First, he mentions the occurrence of a close above a previous high, followed by a reversal back down without a secondary close higher. He interprets these moves as deliberate games played by institutional investors to mislead traders. Gareth stated that by learning how to read charts, one can understand the messages they convey and gain insights that most people would miss. He describes this ability as incredibly powerful. He attributes the success of his call to the information provided by the charts, alerting him to the potential reversal and market manipulation at play.
Algorithms and institutions will play games. They'll push something above a previous high, ultimately to reverse it, knowing that a lot of people will get stopped out on their shorts when it goes above that high, and then also people will go long when it breaks that high. So it's a way of getting most people on the wrong side of the trade, and institutions do this nonstop with stocks, cryptocurrencies, and etc. All right, so what we see here is you got to close above, and then you reversed back down. You got over here a close above, and you ultimately never got a secondary close higher. These were all games by big money, keeping it and kind of getting people to be on the wrong side before reversing. Now that's just part of it. Number 2, you had an RSI negative divergence out there that was massive going on here from this high to this high. You had a higher high, but the RSI was actually declining. You had mass euphoria of double top kind of nature, that if you study psychology and you study human nature, it was telling you that this was the end of a run, not the beginning of a bigger breakout. When you learn how to read the charts, you start translating the charts into the English language or whatever language you are accustomed to. And they do start speaking to you, and you can start to garner information that most people will have no clue about. It is unbelievably powerful. So this was a great call, and again, it was something that the charts were alerting me to.
Gareth explains that he finds the Fibonacci sequence useful in his trading strategy because it appears naturally in nature. He believes that since humans are part of the natural world, these patterns can also influence our behavior as buyers and sellers. Soloway gives the example of the moon affecting ocean tides and suggests that even though individuals may not notice it directly, subtle shifts in sentiment can have a bigger impact when multiplied across a large number of investors.
For me, and I keep it very simple, if you look at my charts, I have a few trend lines on it. Occasionally I'll use Fibonacci retrace. I think Fibonacci, one of the things I love about Fibonacci is that it occurs naturally in nature, right? So the Fibonacci sequence in the petals on a flower, it's in a Fibonacci sequence. The rings on a tree, when you cut down a tree, Fibonacci sequence. So what I'm a believer in is that we are part, as people, as humans, we are part of something bigger on this planet, and we are affected by things like nature is. And so therefore, things that replicate in nature will most likely have an impact on us, and therefore whether or not we're a buyer or seller. People say, oh, the lunar cycles have no impact, this is just astrology and like all this nonsense. But think about it like this. We as humans are 80% water. Okay, the moon affects the tides. All the tides on the earth go in and out based on the moon. If we are 80% water, it makes sense that there's a little bit of an impact. Now, is it so much where I notice that I'm feeling different when the tides are going out or in? No. But if you map that across 1 million, 100 million investors, the slightest change in sentiment can actually be something bigger when it's mapped out amongst 100 million investors out there.
So the point that Gareth said is that it is equally important that we as traders know when to enter the trade and also when to exit the trade, whether it's stock or crypto markets. Also, stay updated and ready for market fluctuations. Let us know what you think in the comments below, subscribe, and see you in the next video.